Welcome back, everyone, to the Infinite Banking with series. On today's episode, we're going to be talking about infinite banking with MassMutual. This has been a common question that we get a lot is, okay, I'm looking at infinite banking. What company should I work with? And obviously, MassMutual is one of those big companies that a lot of people want to know about. We're going to go through the company, when it was founded. We're going to talk about the company's strengths, the COMDEX score, how dividends work, how getting loans work, the average lapse ratio. We're going to even talk about how infinite banking is viewed from like Mass as a company. We're then going to look at some illustrations. We're going to compare cash flow illustrations. We're going to compare front load illustrations. We're also going to dive more into how PUA riders work and the flexibility there. We're also going to look at their long-term care rider as well, and then end with pros and cons and an agent perspective. Buckle up, guys. This one's going to be a fun one and wouldn't be made possible without you, Alden. So I'm excited for today's episode.
All right, awesome. Well, thanks so much for the intro, Caleb. But guys, I am excited. There's going to be a phenomenal video, really great carrier. Let's just go ahead and dive into IBC with MassMutual. So high level, we need to understand a little bit about MassMutual as a company, right? So first and foremost, they've been around a long time. It's 1851 is when they were founded. They've been paying dividends a little bit shorter than that since 1869, so about 157 years. And they are a true mutual ownership company. And we say this because it's important. These three metrics, track record, how long they've been around, and mutuality are big things when it comes to infinite banking style policies. Now, as we dive into the financial strengths and performance of this carrier, there's a couple of key metrics that we like to track. First and foremost is, are they paying a dividend, and is it healthy? Is it a good size based on the number of policies that they have? So MassMutual, they're a very large mutual insurance carrier. They're paying a whopping $2.5 billion with a B in dividends, and that's as of 2025. They're also projecting a very strong dividend interest rate, which is about 6.4 projected rate at this point. So if you just look at those two metrics alone, you can get an idea. MassMutual is a really big company and sells a pretty solid product. The next thing that we look at, this is a new metric to the channel that we've mentioned a couple of times now. This is lapse ratio. Okay, what does that mean? All it means is if a policy is surrendered, so you take your cash out, we take it from one carrier to another carrier, or the internal charges in the policy become higher than the cash value, the policy will lapse. And so that percentage that we're looking at, there's an industry average of around 5% as reported by AM Best. And all this is saying is if we have a low lapse ratio, then that carrier is providing a strong value for its clients, and people like their policies and they keep them long term.
I just think that this is a good metric to look at. And because Mass is such a big company, this is just a super healthy number. And we're going to get later in the episode that they're definitely not promoting infinite banking. And this might be one of the reasons why is they really care deeply about having their lapse ratio be low. And so overall, I also just want to point out the fact that they paid over $2.5 billion dividend. Like, that's amazing. And they are known for having one of the healthiest dividend interest rate projections as well. So it's just like there's a lot of green arrows pointing in the right direction as we go through just MassMutual as a company, like choosing company wise.
Absolutely. And as a company as well, there's a couple other metrics that we like to track, especially for people using loans against their policy. One of those is loan recognition. And so non-direct loan recognition is where MassMutual stands. That means their dividend is not affected when you borrow against the policy. Now, for all those nerds out there, there are some legacy products with MassMutual that did have the ability to do both direct and non-direct, but their current whole life products are non-direct recognition. Ratings. So this is a fun one for me because I like to compare this and make sure we're selling top quality products with top quality carriers. MassMutual is right up there. So they're a top 2% insurance carrier, 98 on the COMDEX score on the A++ superior with AM Best. Now, for those of you who've been paying attention, Mass used to be a 100. They've come down slightly. They're probably going to go back up. Insurance carriers do fluctuate. And as long as they're fluctuating within 2 percentage points, I think it's okay. The big swings are the ones we have to worry about. But overall, Mass is an amazing carrier, and they've amassed over $380 billion. So that's a significant revenue stream that's supporting that COMDEX score as well.
Yeah, Alden, I feel a little bit old in saying this because when I was first in the industry, Mass had the direct and non-direct, and what you're saying is some of those legacy products, but now they're mainly non-direct recognition, which just makes me laugh because I always seen myself as the young kid on the block, but I guess I can't be saying that much longer. So that's
You've been around that block a couple times now, huh? Well, MassMutual as a company, there's some interesting things when we start talking about the positioning around IBC. So what do they actually think? One thing I'll say, first and foremost, is that they have been known for infinite banking for many years. There are a lot of infinite banking practitioners have historically worked with this carrier because they have such a robust product lineup and a great dividend. However, in recent years, so going back to about 2022, I remember when this happened, Caleb, there was a whole bunch of confusion in the industry about, hey, can we use them? Can we not? They've effectively come out with an anti-IBC stance. Initially, that was privately among its distribution channel, so the agents that it worked with, but then it came a little bit more public. And what they're saying is that they are distancing themselves, and they definitely do not condone the IBC style marketing. There's a lot of reasons to this. Caleb, if you want to go into a little bit of the history, you can. But the concept is, with dividend interest rates fluctuating, with loan interest rates fluctuating, there were quite a few insurance agents that were encouraging their clients to maximum leverage their policies very early on. And when all of a sudden the dividends were not as high as the interest rates, those policies were lapsing. And so that lapse ratio that Caleb mentioned before was effective. And this is what really drove this stance. Anything else you want to add to that, Caleb?
Couple things. Number one, MassMutual is a massive company, and they have a big career arm, which essentially means they have lots of people that just primarily work for MassMutual, and that there's pros and cons to that. But the pro is they employ lots of people that promote their deal, and so one of the things that every company, like when it comes to endorsing or allowing different sales, is some insurance companies feel like they need to be more pro some of these things for business. And Mass is so big where they're like, no, we don't need, like, the infinite banking space, the marketing space is so small compared to what they're used to. They see it more as more at downside than upside when it comes to like what they're getting from a premium standpoint. And then the other thing that I've heard, like kind of inside baseball, is there was some agents that just gave them a bad name. Like they were like, put your money into here and then like, let's buy your groceries next week and stuff. And like there's crazy loan volume. And it's just, insurance companies are pretty clear. They do not want to see them as a checking account. And then the other thing is, these companies also have to look at just the liability. If they don't want their name in the news at all when it comes to giving them a bad name. And so I think their whole deal is like, hey, if you're using infinite banking and sales, like we do not endorse that at all. And so I would just say there were a lot of agents at the time that walked away from Mass because they're just like, this company does not have my back at all. And I think it was very much like they don't like early loans. They don't like people going overboard when it comes to that type of strategy. And so that's what I would say as it relates to maybe why the company took a stance there. And they were justified in some areas, but they did take a pretty harsh stance back in 2022 when they made that memo. And I will also just say they're not anti-overfunding policies, taking loans. And so, but out of all the companies that we've worked with, there have been some of our clients that have been questioned about the loans that they've taken. They've never been limited, but it's one of those things where sometimes they want to know, like they may take like the anti-money laundering thing more seriously than other companies. So they have question, and that also, as you can probably imagine, can put a bad taste in your mouth. You can still get your money, but it's like we almost want, we sell this as a way of like, this is a private contract and strategy, and insurance companies really are not in the business of deciding whether you get the money or not. So they weren't trying to like approve, can you get the money or not. They just wanted to ensure that it wasn't anti-money laundering. And I think it was all around that same time. So maybe that was a little too much, Alden, but I just want to give a little bit of context to why they've taken a harsh stance.
Yeah, context is definitely helpful, Caleb. The history behind where we are today is just good to understand. As we continue to walk through, you'll notice that we still support MassMutual. We still sell their products. So this isn't a disqualifying area but it's just something to be aware of. So we'll continue to dialogue about that as we go forward. Now, regarding products, MassMutual has a very diverse product lineup, and it's kind of a joke in the industry of whenever an insurance agent thinks of, hey, that would be cool if, they're calling MassMutual because MassMutual always comes out with a brand new product. They've got a 6-pay, a 5-pay, an 8-pay, a 7-pay, like all these different things. So because of that, they have a lot of products and tools for insurance agents to use depending upon the situation. And so because of that, there's really 3 products that we look at for the purpose of high cash value policies. And that's going to be the Whole Life 100 product, very standard across the industry. They also have a product that is quite literally called the High Early Cash Value Whole Life Policy. So I'll let you figure out what that does. And then we've got the 10-pay Whole Life Policy as well. So this next section, I think, is where a lot of people are excited about. They want to look at the actual numbers. So I have some illustrations for us to look at here, and we can dive in.
When we talk about the cash flow strategy, that's our way of saying that we're going to illustrate someone putting in the same amount each year. And obviously there's flexibility within that, but that's someone that's maybe wanting to put, I think the example is $50,000 a year. Again, there's flexibility. We'll walk through that. The front load strategy is someone who's sitting on a lot of money up front. They want to put it into a life insurance policy, but they don't necessarily want to put that in ongoing. And so it's like you'll see first year, a lot of money going in, and then the second year, less. And there's still flexibility built around that. But that is for someone who's sitting on money, wants to direct it into life insurance, but doesn't want to have that ongoing commitment.
And so what we often see with cash value strategy is that that's going to be the most efficient. The way we build policies at BetterWealth is we're trying in most cases to maximize the cash access to you as a policy owner early on in the contract. And so for those who recognize ratios in the IBC community, 1090, 40/60, there's a lot of things that we can do to a policy. The ones we're going to show you today are maximum cash value. So the highest degree of efficiency for that premium of 50 grand. Now, MassMutual, a lot of really cool things we can say about the company. Their early cash access can be between about 75 to 85%. Now, depending upon the product, and as I mentioned before, there's a lot of them. Sometimes you can get a little bit higher than that. But for cash flow strategies, paying a long time of the same amount of premium, this is what we see early on in year 1.
And Alden, I don't want to go too off script here, but when it comes to mass, you potentially could get higher than 85%, but there's trade-offs, and a lot of times that trade-off comes with long-term growth. And so when we were designing this presentation, we wanted to think through what would we do for ourselves? What would we suggest? And so we're showing you what we believe is one of the best ways to design a policy with mass when it comes to all these things.
Absolutely. And we'll touch on that briefly in the front load section as well. So the Whole Life 100 product, specifically when we're funding it cash flow style, it's really designed for long-term funding. There's some other reasons around this, especially using their PUA riders. There's some limitations to where you can't quite be as flexible, so you need to plan to fund it for a long period of time. But at the end of the day, if it's funded as illustrated, we have a strong internal rate of return, somewhere between 3.9 to about 4.6%, given the current dividend performance and projections from this insurance company. All right, so diving into a sample illustration here for a cash flow. This is going to be on a 40-year-old male. This is one level above standard, so they're a select preferred rating. And then we're going to be looking at that Whole Life 100 product. Now, Caleb's mentioned this before. We are going to be doing an apples to apples comparison across all the carriers for this type of design. So if you've watched our other videos, you know it's going to be 20 payments of $50,000 a year and then big goose eggs starting in year 21. So what's happening is now we're telling the policy to pay for itself. It's well capitalized and it can just continue to pay that minimum charge of insurance while maintaining the cash value performance in the death benefit in the policy. So right away, a couple of things that we'll notice is when we're optimizing a long-term cash value focused policy, we have around the 75 to 85% cash in the very first year. Now, to Caleb's point, we're going to see a little bit higher percentages in a couple of the other products I'm going to show you. But when we're looking at long-term funding, this is a really solid product to do it. So pull out some numbers here. 50,000 in the first year, about 37 and some change coming in cash value at the end of the first year, including that dividend, about $1.3 million death benefit. If we scroll forward, look out here to year 20, we've got about 1.51 million in cash value. And then we have here the $3.9 million death benefit. Now, something that I really like about insurance illustrations when they show this metric are 2 things. 1, the capitalization point in the policy, and then 2, the break-even point. So capitalization point, this is just when the policy starts to give you more cash than you're giving it. And what we see is this happening around year 3. So this column here is a net annual cash value increase column. So what this is saying is in the first year, you put in 50 grand, your cash value goes up 37.5. Put in another 50, goes up 40. The story repeats until we get to about year 4, put in 50, and now it increases by more than 50,000. So the cap point, if you were working with me as a client, would be in year 4.
The break even is just essentially meaning that you have more money than what you've put in. And this would be like, obviously no one would want to start a policy to then cancel. Like that would be something I just want to be very clear. That would go against everything that we teach. But that does just show you that you have more money than what you put in. And it's something that we like to monitor. A lot of people will say that break evens are 15 to 20 years out if it's a policy that's poorly designed with a bad company. And all in this whole series, you see something very common that you're seeing break evens anywhere from 5 to 8 years. And you can see this one is in year 7. And so all that means is you have more money than what you put in. We like to look at that when we're comparing other carriers and just seeing like the efficiency wise.
Yeah. And to Caleb's point, when we look at it from a comparative standpoint, there's quite a few metrics that we look at. The internal rate of return, as I mentioned on the other screen, that's one of them. It's a very important one because that shows the life of the contract. Break even is how efficient we are early on. In some carriers we work with, you may break even in year 4. Others may be closer to year 8. But long-term performance doesn't necessarily follow which one broke even first. And so I think that's just important to understand. MassMutual, their contract, even though it's breaking even usually year 6, year 7, depending upon ratings and funding, it's still a very, very good long-term performing contract.
The other thing I would just point out is the death benefit is increasing pretty significantly, and it'll be interesting as when we compare all of the companies. I just would be really curious to see how this compares to the other companies, because it's cool to see the death benefit start at 1.2 but go up pretty significantly as you go. And that's another thing that people will say is they steal your cash value kind of deal. Well, your death benefit is increasing greater than your cash value build up, and so by definition it's not as much of a talking point as some people make it to be if you design policies correctly.
Absolutely. And we'll jump into some other products here. A big point I've mentioned in other episodes as well is if that death benefit's not close to doubling every 10 years, you're probably not looking at a well-designed cash value focused policy. Now there's some exceptions to that, but that's the general rule that I keep. All right, so coming back around, looking at the front load strategy. Now, Mass has a lot of products that we could be looking at, but there's 2 specifically that stand out when I'm building a front load design. Those 2 are the whole life 10 pay option and then the whole life high early cash value option. When we look at these in general, front loading an insurance policy, most of the time, it's a client that we're working with that wants to reposition capital, idle capital, either in a business, in a bank account, maybe they had a liquidation, so they sold something, right? And they just want to move money from this pocket to this pocket within an insurance policy. So what we do and the way we build these is we're going to maximize that early cash value in the very first year and then plan to pay a smaller premium moving forward. What this does is it gives us a larger volume of money in the policy to accelerate the compounding. And then we also have a large degree of liquidity very early on if we wanted to borrow back against that to then go purchase a business or fund a new investment, right? Or finance a car, as there's lots of videos on financing cars in IBC. And so those are some highlights to what's specifically unique about a front load. Now, something I'm going to mention, I've mentioned this almost on every episode so far, is the internal rate of return on a front load technically is going to be less on average than the cash flow. So what am I saying? Think about it this way. If we're putting in more money, I have to buy more insurance to keep the tax favorability, the non-MEC status. And because of that, we're buying more insurance, more internal charges, and then we're dropping the premium. So the average growth is going to go down. So this clocks in about 3.8 to 4.5 given current dividend rate and projections, which is slightly below the cash flow.
Yeah, the only thing I would just add to that is you're starting out with more money. And so that's where, IRR can take a slight hit. And sometimes it still makes sense because you're earning on a greater volume. And that's one of the things that Nelson talks a lot about in his book, is talking about looking at the volume and not just looking at the rate.
Absolutely. And the last thing I'll mention on this slide, and then we'll start looking at some illustrations, is the high early cash value product itself. There is some general concern because of how much cash this creates, how the dividend disproportionately, let's say, affects this particular product. When we run really, really tight ratios, let's say 1090 designs with quotations, there is some potential risk with dividend fluctuations that the policy could become a modified endowment contract. And so our stance at BetterWealth generally is to use the HECV for front loads. The reason this is okay is we're putting a lot up front and then immediately decrease that second year premium. This gives us the best of both worlds, where we can have a very efficient policy, but also get out of any concerns of mecking the policy down the road. All right, so jumping into this particular illustration, Here comes that 90% number that a lot of you are looking for. So with the HEC-V, if we're doing a front-loaded design, we can get over 90% cash liquidity early on in the policy, which is a phenomenal thing. There's only a handful of carriers that can get that much cash liquid early on. Putting in first year, 100,000, about 92.5%. And you'll notice that that death benefit has increased. It's practically doubled because we're putting in more premium. So we have to have more insurance. We reach that cap point I mentioned before in year 2 because we've accelerated the growth of this policy. We put in more volume, have more compounding, and receive a larger dividend the second year than what we would have otherwise. The HEC-V itself, it just generates cash faster. Base premium drives cash value farther and faster than most traditional products. So we get to that cap point very quickly. Break even, again, I'm gonna go from 7 to 4. So this is why I like this product a lot for front-loaded designs, because we get volume, high liquidity, and a very quick efficiency out of the product that is sacrificed a little bit by long-term growth. I mentioned that before. But if we look out over a 20-year period, we still end up with a very strong cash value in about 20 years and a projected death benefit as well.
I love this, and it's a reason that MassMutual is high on our list when it comes to front loading policies. This is also very flexible as well. So this is a very flexible policy, gives death benefit, really attractive death benefit increases. You're seeing a capitalization phase of 2 years. That's pretty great, and a break even at year 4. And even in the first year, you're having over 90% access. So overall, again, don't want to nerd out a ton, but I just love life insurance. I just love life insurance when designed and set up properly. Like, you're protecting your family, you're creating a pool of liquidity, and it's just really cool to see this in real time.
And so we'll be diving into these numbers more specifically when we do a larger comparison across all the policies and carriers that we're looking at the end of this series. Now, switching it up on you, both of the insurance products we've looked at so far in this episode have been pay to 100 products. So you can pay them far beyond the 20-year time frame that I was illustrating. What we're looking at now is a 10 pay. So only 10 payments can be accepted by this insurance contract. This is a great option for people who want to do it very quickly and then be done with it. All right, so we want immediate liquidity, want to fund it for a couple years, and then let the policy just take care of itself. Now, short pay products are, in all practicality, the most efficient cash value generators. But what you sacrifice is optionality. Oftentimes a larger minimum premium, and oftentimes you cannot fund it past that 10 pay or the 8 pay or that time frame indicated in the product. In the first year, we still get over 90% in cash value, a lower on average death benefit, has to do with the time frame being squished on the payments for this policy. Cap point is still almost in year 2. We adjust that slightly. But what we'll see is in this type of product, the long-term internal rate of return, if funded the exact same amount of time as a whole life 100 or a HEC-V, this product's going to be a better performance. The big reason is that all the charges in the policy go away in year 11. So now it's just a cash value performer. It's just the dividend and the guaranteed growth driving this policy contract long term.
Yeah, it's well said. And internal rate of return matters, but where I would caution someone, it is like if you can continue to fund, obviously, why not continue to fund into a policy like this? But there are some people, especially when it comes to maybe retirement strategies and all, where they don't want to continue to fund and they're looking at a short pay window, and knowing that you can do a front load and a short pay. It's my understanding that it's somewhat unique. Not every carrier does something like this. And so I appreciate you sharing this style of a policy. And it's definitely something that we've used, especially if someone has that, again, limited time horizon, but wants the benefit of early cash value, because a lot of 10 pays out there give you awesome benefits after 10 years. But a lot of the trade-off is you have very little cash value in the first couple, and this kind of eliminates that downside on a 10 pay.
All right, so that segment was definitely for the nerds. Diving into the numbers, we're going to look now at the more general. How can I actually access cash value in a policy that I have with MassMutual? A couple of the highlights that I think are really, really great for this company is you can get loans pretty quick, usually 30 days, sometimes 45 days, depending upon the premium size. You can initiate a loan very, very quickly. Now, because they are non-direct recognition, they do have a variable loan interest rate. Now, MassMutual is kind of unique. Every company approaches this differently. But right now, the way that they use or assess, they assess this interest rate is they basically change it every single month. Every single month in a year, it's changing, but it's only changing for the policy owners who have an anniversary in that month. So if I had an anniversary today and the interest rate today is 5.8%, I get locked into 5.8% for a year. Next month, interest rates drop. Someone else has a policy anniversary and it's now 5.5. They're locked in at 5.5 for a year. So that can be a little frustrating if you and your wife got policies and you got different loan rates. But hey, it's just every company is a little bit different. Now, two other cool things with this company is that we can do online loan initiation. Now, to be honest with you, I've had mixed reports and I don't truly understand if it's going to be product based or if it's loan size based. Some of our clients have been able to initiate loans up to 50,000, some over 50,000 through the portal. We're not exactly sure why. So that may be a nuance within MassMutual that someone can educate me on in the comments. Additionally, MassMutual also has a mobile app. So for those of you who want to take loans on the go and you're on the hustle, you could do that if you really wanted to.
It's just funny to me because they're like anti-infinite banking, and then they make it like they have an app where you can take a loan. It's irony at its finest. Dom on our team has a MassMutual policy and has used the loan feature online and has said it works really, really well and super convenient. And so it's cool, and it's definitely something to know when it comes to this series.
MassMutual is just interesting. Like let's name a product high early cash value, but we also don't want you to use it, but also you can use it.
And it's my understanding that because they have lots of business for banks, so they do bank-owned life insurance, and that high early cash value product I think originally was designed for bank-owned life insurance, but then like everything, it's like, whoa, could we use this for personal? Yes. It is interesting that they have some interesting products that can be used or manipulated for personal.
So for larger loans, you got to go through your agent. Usually there's a form involved or go directly to the carrier. Now, this is just aligned with anti-money laundering regulations and to make sure it's best practices to have that signature verified. But at the end of the day, accessing cash value with MassMutual is very, very simple. And they are on, in my opinion, the best way to do interest accrual, which is just a daily interest accrual. So you're charged on your daily balance at an annualized rate. So the math on that is very simple.
Hey, I'm interrupting this video briefly to say, if you're serious about using whole life insurance for infinite banking, we have a free gift for you. It's called the IBC Company Guidebook, and it gives you inside access to the data behind these videos. Things like life insurance company COMDEX scores, their dividend performance, how they approach infinite banking style policy designs. It's all the information we cover in these videos organized in one place for easy reference. To access the guidebook, click the link in the description or pinned comment. Now let's get back to the video.
So guys, buckle up. This is going to be an area we're going to spend a little bit of time on. One of my biggest issues with MassMutual is that their riders are a little bit complicated and they're not straightforward. And depending upon which paid up additions rider, it's what we're going to look at here, that you choose, you may be in some trouble if you thought you chose the other one. And so this is where working with an experienced agent is really important.
Yeah, and there's this slight commercial for ourselves, like plug. But I would also just say this is I think people underestimate when people are comparing like what company that they should work with. This is something, the PUAs aren't necessarily something that people talk about. They're usually looking at just the illustration, but PUA flexibility, can you backfill? Like all these things are important that, again, other than us, and maybe I've never seen other people make videos on this. Maybe people are, but this is something that I think we're introducing in this series that has not been talked about and should be talked about and should be considered when you're thinking about doing a strategy like this, because life doesn't act perfectly. And so you want to understand, can I work with a company that creates more flexibility and optionality? And I would put a premium, no pun intended, I would put a value on more optionality and flexibility. So with that, get your notebooks out and Alden, take it from here.
All right, so there's two main paid up additions rider at this carrier. We have ALIR and PALIR. And yes, they sound the same if you say them quickly. So be careful when you're talking to your agent. Now, the additional life insurance supplement rider, everyone else just calls it a PUA, massive special. So this is what I call an all or nothing paid up additions rider. So I'm going to go through some highlights here. And if you decide to go with MassMutual, you need to understand these limitations because they can be big if you're not expecting them. The reason I call this an all or nothing rider is, let's just say for discussion's sake, you've got a $5,000 base premium and a $25,000 ALIR paid up additions premium. This premium is due on the anniversary every year in full, period. No flexibility. So if you're funding this with a high degree of confidence, great. You just hit that every single year. But if you don't have all the capital on the anniversary, you got to pay zero. That is a pretty limiting factor. The other aspect of this is that some carriers we work with allow you to skip premium payments for a couple of years. If you hit hard times, or you can't fund the policy the way you thought you would, they allow you to skip payments and then come back in a couple of years and keep funding. Mass does to a limit. And so you're allowed to skip a maximum of 2 paid up editions annual payments. If you skip those, the next year you're done. You don't have any option to continue that rider. It will be automatically canceled off of your policy. Now, this is actually something I like about this rider. So it's not all tears and depression, but it is something that's important to understand. They have a backfill option that, in my opinion, is actually the strongest in the insurance industry for paid up editions. It's kind of interesting that we have very strong, not so flexible, and then very strong, like, oh, wow, this is really unique. This backfill is industry leading because if you do skip those 2 years, starting that 3rd year when you have to come up with something, you can come up with the last 2 years of premium as well. So in that example I gave, $5,000 base, $25,000 ALIR PUA, you put 0 in there for PUA for 2 years. Starting that 3rd year, you can put in 25 for that year, 25 for the previous year, and 25 for the year before the previous year. That's a lot of catch up very, very quickly. And so for some, this could still make sense because of that backfill option.
Could you just put $1 into PUA and just keep that thing alive? Like, would there be like even if you came upon hard times, or is it's all or nothing?
It's the all or nothing paid up editions rider.
Don't love that, but it is interesting on how the least flexible on the funding creates the backfill strategy. So yeah, I've very mixed emotions about, or opinions about that, but it's interesting.
Most people do. And then it's really, really rough when I do policy reviews with people and they have this rider and they didn't understand how it worked and they've been skipping premiums. I'm like, oh, well, now you can't, you got to go back and underwrite it. And so that's really important to understand. If you can't pay the full illustrated amount, you have to pay 0. The last thing that I'll mention is the maximum premium on this rider. It's underwritten from the start. That maximum, whatever amount you're supposed to pay, you can't go more than that. You can't go less. It's there. That's why we call it the all or nothing rider. So hopefully that was clear as mud for everybody involved. Anybody working with our team.
Again, we want to be as objective as possible, but is there any value in having something like this? Or is it like on a 10 pay, if you know, like you already have money set aside, does the rider itself perform better than maybe the next one you're about to talk about? Or is it really like, knowing what you know, put the other rider on?
Yeah, so I think there's a couple things I'll say about that. The rider itself isn't technically more efficient, but what it does do is it requires you to be on top of your game. And so if you're paying the policy anniversary every single year on time, your policy is going to perform better than someone paying it a month late, right? Because you get the money in there faster. So that forced obligation can be beneficial for some people. Most of the time where we see this working is if we're doing a strategy where, let's say we're using an annuity, like a single premium immediate annuity to fund an insurance product, we can use this rider because that premium is guaranteed to come in every single year. The other one, you mentioned it, short pay products. And a lot of the clients that we work with that want to do short pays, maybe they're trying to fund an insurance policy on a grandchild, and we're going to put that into a trust. And that trust has capital to pay the premium and it's already set up. We don't need flexibility. You can just throw this on there. I can just shove the premium in there every year as it's needed for that short pay. Caleb, you make a really good point. Myself definitely included, value flexibility so highly. So for most of our clients, we just don't end up using this particular rider. Now, this next one, this is the PALIR, Planned Additional Life Insurance Supplement Rider. It's just the other PUA. Now, this one is more flexible. All right, this is where you can have year to year, minimum, maximum, very similar to other carriers that we work with. You can shove in money in any dollar amount. There are some limitations. The first couple of things to understand, there's like a high water mark. That's the way our director over at Mass Mutual described it to me. Year to year, if you have the ability to put in 25 grand, but let's say you choose to put in 20 grand for those 2 years, well, starting in 3, your high water mark is now 20,000. You can't go back up to 25. So this is another limitation. You don't have the ability to have a yo-yo effect and fund low for multiple years and then fund up to the max. They will adjust your max down to that high water average of the last 2 years. That can be a problem for some people and a big limiting factor with this particular carrier. Now, I mentioned you can go 0 to $1 million or whatever is underwritten in the policy year to year. You have that flexibility, but you can only make 3 payments. So that's the other side of this that isn't actually super helpful. So if you do plan to fill it up over time throughout the year, you can only do it 3 times. So in that 25 grand example, you can do 5, 5, 5. Well, you didn't quite get to 25 in total. that you can't put any more premium in. That is a limiting factor. Now, the big pro from the previous rider was the backfill ability. With this rider, even though it's more flexible, they take that away. So now we don't have any backfill ability at all with this particular rider at MassMutual. And then finally, you can skip fully your paid up additions rider payments only for 1 year. If you skip it for 2 consecutive years, the rider is canceled. So again, this speaks to the market that MassMutual as a whole is marketing to. Financial advisors, specific retirement focused insurance products.
I think that was well said. This is if you're an entrepreneur who likes the flexibility of funding, and there's other companies that are way more willing to say, hey, we're going to work with you on the flexibility. And I would not put MassMutual as high in that category. Even though if you stick to the funding period, it's all good. There's some flexibility, but I would say that this is pretty weak compared to some other carriers out there.
And unfortunately, that is correct. Now, one just fun thing to note is that even though we only have 2 paid up additions riders, sometimes we have a saving grace within a MassMutual product. One of the term riders that we can use with this carrier, it's a blended term. I'm going to plug a video that I did with our head of sales, Demetrius. We go over different types of term products. And with Mass, we have a blended term product. And what this does is while we pay premium into blended term, it's actually also creating cash value and converting into permanent insurance. MassMutual is a little unique in that they allow you to, what I call, flex that life insurance supplement rider, that LISR, to accept extra premium up to the MEC limit. What it's actually doing is it allowing you to buy out the amount of term on the policy and convert it into permanent insurance much faster. Again, cool saving grace, not a funding strategy. There are some illustrations and some product designs that I've reviewed that's using blended term as the way to fund and build cash value instead of PUA. There's a lot of reasons I don't like that. We're not going to go into that in this particular video, but understand if you have a policy and you've lost flexibility with these PUA riders, if you have a LISR, you may be still able to put in additional premium. All right, so things to know about MassMutual. Apart from everything else we just covered, a couple other things. MassMutual is one of the few carriers that we have access to that can work in the state of New York. Some of the smaller carriers, they choose not to because New York is just annoying for insurance. Mass, they're massive, been around for a long time. They do have that ability. The other thing, and this is just a product nerd thing, whole life insurance, when we do survivorship products, so 2 people in 1 insurance policy, they often limit the insurance riders that we can use. MassMutual for survivorship, it allows me to use blended term. It's the only insurance company I work with that has that option. So it gives us the ability for survivorship policies to still be very cash efficient because we can add term. That term is going to create cash and we can put on PUAs. And last thing, only a handful of carriers, again, offer this is they do have long-term care accelerated death benefit riders for their whole life products.
That is a big benefit if someone wants a traditional long-term care. Most insurance carriers that we work with have what's called an accelerated death benefit rider that can be built in that some people could compare that works similar to long-term care. It's obviously not a long-term care rider. And so obviously this is something that someone wants. MassMutual is one of the few carriers that can not only give you a really competitive product and include a traditional long-term care rider. And so this is one huge benefit I think that Mass gives if that's something that's really important to someone that they want it embedded in their life insurance product.
Absolutely. And that long-term care, the rider, it's not like a separate policy. You add it on, and what it's doing is it's accelerating the death benefit like other accelerated riders, but it's doing it within the IRS definition of long-term care insurance. All right, so the final 2 slides of this presentation, the advantages and disadvantages, the pros and the cons. Big things with MassMutual is they are a major mutual insurance company. They're actually the 3rd largest mutual insurance company in the United States. They've got a 150-year track history for dividends. They are consistent. They have a high product selection, very diverse, and something we didn't mention, which is just kind of cool. A couple of years ago, they came out with what's called a Living Well rider. So if you are one of those individuals who have a Whoop or have an Apple Watch or Garmin, things that track your physical metrics, you can tie that into your MassMutual policy. And what it does is it makes the policy cheaper over time, which makes your cash value performance all that better over time as well. So if you're really health-centric, health-focused, this could be a great carrier for you, understanding the limitations that we did cover as well. All right, so some considerations. And these are ones that we just need to be aware of if we do business with MassMutual. They do, in general, as we discussed, have like an anti-IBC stance. Not anti-whole life, not anti-high cash value, but as a whole, they're not fond of the marketing that's done around the infinite banking concept And some agents, because of that, actually are not allowed to work with MassMutual. We had some agents get removed from distribution. Now, we still have our contract. A lot of really good agents do. So it's still available. You just got to be careful with how you market your insurance products. Another consideration to be aware of is that limited PUA flexibility. They've got 2 PUA riders. They're flexible in different ways. If I could marry them together, we'd have a really banging insurance product, but we can't do that, unfortunately. We have a lot of comments in with our current MassMutual team to get that fixed in the future, but we're a small fish in the grand scheme of things. Another consideration, and our clients who have MassMutual policies know this, the life insurance supplement rider, that term rider I mentioned, they can send out some really funky annual statements that are just confusing. So this is more of just a con for me because I get tired of explaining it. But to be honest with you, MassMutual, it'd be great if they simplified the statements and just made it more clear. And then finally, because of the vast majority of MassMutual agents and how they are career system based, they're not technically, or I should say, they're not often trained on high cash value focused policies. They just have a different focus in their career system. So finding the right agent can be tough. Hence the shameless plug that Caleb did earlier.
Yeah, book in our link down below on our team. Yeah, I would say that, yeah, that's obviously true. Is in any company that you work with out there, we might take for granted. I know I do that. I almost think because we're in it every day that most insurance is designed this way, and it's less than 2% is designed in the way that we're going the extra, maybe even 2% is generous because we just don't know a ton of people that are doing stuff like this. And so obviously that's a huge disclaimer in every video that we do. Yeah, MassMutual definitely, I think part of the reason they did the memo is so that they could take action and can people that they didn't want, that they didn't. So I almost see think of the anti-IBC stance as just a precedent to say, hey, if we see you doing some sketchy things, or if we see you marketing in such a way that we don't go, you're out. We got contacted immediately that's saying, hey, you're going to see something. Don't worry. You're fine. Because again, we've been pretty consistent. But then, yeah, I would say that the confusing LISR term that can be frustrating, and never underestimate the power of simplicity. And so that is something. And then obviously the limited PUA rider is one of those things I think we spent enough time talking about, but I can't stress enough on how that is definitely something that is, it just goes back to MassMutual is not necessarily in the business of trying to make it really, really flexible. This could be, on playing devil's advocate, could be an advantage that they say is we're designing this in such a way to make people not be attracted to this type of product if they're maybe wanting extra flexibility, because they may not want that. And so we're seeing it as a consideration, but they might actually see it as an advantage. And I think in all of these things, these companies are really calculated, and it doesn't surprise me, but it's something that is important because it doesn't show up on an illustration. You can see an illustration, it looks great. Some of these things that we're mentioning don't necessarily show up on an illustration.
All right. So because I used to be on the outside, now I'm on the inside, right? Working with BetterWealth. I want to give an agent perspective. So compensation, it's great. It's average among the industry. A lot of insurance companies that work in the state of New York have to have a certain compensation level. So nothing too crazy. However, I think old mutuals can have a hard time getting caught up to speed. And so tracking commissions can be a little bit cumbersome, and verifying that you're getting paid accurately can be a little bit cumbersome. But I think also that comes down to whatever general agency you're working through. So just something to consider and ask questions about that for sure. So on the resource and support side for insurance agents, resource and support is good. They're very, very professional focused insurance company. That said, they do focus a lot on their career system because that's their bread and butter. The majority of their business is written through the career agency system. The strategic distribution arm, so independent advisors, it's young, still working out the kinks. They've had a couple of these iterations over time. And so the support is not always the best, but it is something that they are improving upon. Product complexity, I think because this is almost an hour-long video, you kind of get this. It's fairly high as far as comparison to other insurance carriers that we're going to work with. Because the PUA differences, the 2 different riders, the LISR that we didn't even go deep into, those have some complexity that is just hard to communicate to clients as an agent. You have to have a really good understanding to do that. And lastly, and this is just my pet peeve with Mass, please update your illustration software. I just love it so much if you did that. It's a little bit clunky. Great software, can do a lot of products, do a lot of different things, but I find it personally a little bit clunky, and these are my opinions, not yours. So that's why I put that in there.
Yeah, no, and I just want to give our our team that we work with a shout out, I think, for the product complexity and the illustration software. They make up for amazing customer service. But again, we can only speak for our experience. Some people have not experienced that. And so we've just happened to be with a really, really good team. And so they make up for some of the cons. I would almost imagine that the product complexity potentially would be higher if we didn't have such a good experience of working with people. And I think that this summary is very, very well stated. And again, for people like ourselves that work all across the country, you need carriers that are competitive, that you can work in states that not every insurance company works in, i.e. New York. And so, when it comes to Mass and New York, they're at near the top, if not the top of the list when it comes to companies that you can work with and do well.
Yeah. And the team we work with at Mass is incredible. And I tell you who they are and say, go talk to them, but they probably wouldn't like that because of the title of the video. But if you want to know, you're trying to get appointed with Mass, reach out to us. We'll get you with the best team in the industry. All right. So final conclusion here. The thing we need to understand is that Mass Mutual, massive insurance carrier, they are a legend in mutual insurance in the IBC space, and they provide very strong and robust insurance products with a great dividend history. Because of the structure of their policies and their stance on IBC, they can be a little bit difficult to work with, and their PUA rider inflexibility can be hard. So this is something that our team over at Mass knows that they're often not our first stop for insurance products because of some of those limitations. But in the right circumstance, we sell Mass a lot. It's a very, very good carrier, and we do like working with them. And so my good friend Margot Robbie said something very, very profound that I just want to highlight here, is that the product and its design, your understanding of that product is far more important, and it matters more than the carrier choice among top mutual insurance companies. And so, Margot, hit it out of the park. Well done.
You wait to the very end to have a joke. I love that. My conclusion would be very simple. Like, if working with a carrier that's been around for a long time, that has tons of reserves, huge dividends, great ratings, like there's trade-offs in our space. And if like that's really, really important, you may take a back seat on some other flexibility. And so it's rare to say every company checks every single box. I would say the people that come to us who have a company in mind, Mass is near the top because they've seen videos online and they're like, hey, what do you guys work with Mass? Absolutely. And many times in the process, we'll show them Mass and some other carriers. And some people be like, you know what? I really, really like working with a company that I've, seen on TV. If you go watch hockey and stuff, you'll see like they sponsor hockey teams. It's like, I like that. And then other people are like, you know what? After looking at everything, would rather go with another carrier. But usually if people are like, I want to utilize my cash value early, we try to steer them away from Mass. And rightfully so, because we're like, hey, Mass has been pretty clear that they don't like early usage of loans. And so while it's not like you're not able to do it, but if we know someone that wants to utilize their loans pretty early on, that's another consideration to just think about. And because we want to play nice with the carriers, and we feel like Mass Mutual wouldn't be alarmed on that. They would actually appreciate that we're trying our best to make sure that we're connecting people with the right carrier, and the carrier appreciates that type of business. I would say, obviously, we're putting on this series to provide massive value to not only people in our space, but you as you're trying to figure out, hey, I've heard about infinite banking. I'm curious about how the different carriers view it, and the pros and cons. And so, number one, if you want to work with someone who understands infinite banking and how to design these products, reach out to us. We'll have a link down below. If you already have a policy, if you have a policy with Mass Mutual and you're like, hey, I want to see how this is designed, what are some options here, we would love to help you review that. And then obviously this whole series takes a lot of work. Alden, you've put a lot of work into this whole thing. And so I just want to commend you. And so I would say, if you find this valuable, commenting, sharing, liking, all help. And then it just helps tell YouTube to say, hey, I really appreciate this YouTube channel, and it gives us the ability to continue to keep moving on. And so all that is really appreciated.
Absolutely. And the last thing I'll say from my side, guys, if you want to get updated as we go through this series, we got a lot of other carriers to still work through, and I'm going to do a big summary at the end. Hit that subscription button to get notifications, and then you'll be notified when we do additional videos. All of them are going to be in that IBC with series titles. You'll be able to find them. So awesome. Thanks so much for your time, guys. See you on the other side.